Just joining us, this is Taking Stock on Bloomberg. You'll recognize the music. You won't recognize me. I'm Michael McKee, sitting in for Pim Fox. He's taking a well-deserved break. Well, there was another encouraging sign for the economy today. The Institute for Supply Management said its gauge of economic activity in the Chicago area rose to 50. That's the highest it's been since last September. 50, the dividing line between contraction and expansion. Is it also the dividing line between whether to buy manufacturing stocks or stand back and wait? Holden Lewis is a manufacturing industrial analyst at BB&T Capital Markets. Well, Holden, should we all pile into manufacturing stocks? The recession over?
Well, I will say this, Michael. Typically, you do not see multiples contract significantly when the PMI is expanding beyond 50. You mentioned the Chicago index a moment ago, but tomorrow we'll have the ISM, the broader ISM national index, and that also is knocking on that 50 metric. And should we inch closer to that and perhaps even get there or break above it? I think that is a good sign that the rally that we've seen in industrials indeed does have some legs yet to go. So I would argue that this is still the part of the cycle where people still make money in the industrial stocks.
Of course, as an economist, you learn that there's always fine print in the economic data. And the thing about Chicago is it was based a lot on automobiles, and we had the Cash for Clunkers program. Are we pulling forward some manufacturing demand that's going to go away, or can we really support a broad-based rise in manufacturing?
Well, I think that there is support for a broader-based rise in manufacturing. First, with regards to the Cash for Clunkers, that information, you no doubt pulled a little bit of demand forward. On the other hand, people are talking about production going from 7 or 8 million units back up towards the 12 to 13 million units on an annualized basis. And pulling forward 700,000 units, while that may have a short-term drag, that clearly doesn't get you or pull forward all the units that we think that we need to get going forward. So I think any impact from that would be relatively minor. On top of that, we're seeing the better PMI indices, not just in the U.S., but you're also seeing it in China, which is already north of 50, and that's helping the Asian region. It's also helping Europe, which, though that was quite a laggard there only 4 or 5 months ago, Europe also has really been playing some pretty good catch-up, and their PMI is approaching 50 as well. So I think that there's certainly a broader bottom in place than just the automotive sector. How that's going to translate into growth as we go forward for the next 6 to 12 months is still an open question, but certainly a bottom looks like it's forming and looks reasonably sustainable.
Well, we'll talk about some individual stocks in just a moment, but first, in terms of how this bottom broadens out, is it a sector-specific thing where certain things are in demand and so we're going to see production ramp up? Or are we going to start really at the bottom with the tool and die companies, the people who make the products? Are we going to see some industrial investment?
Well, I think that you probably won't see a lot of industrial investment, Michael, and the reason is capacity utilization right now is extremely low, and that's going to need to get a fair bit tighter before people are going to make $1 million investments in equipment. However, what I think you are going to see is you've been in a process of destocking here over the past 3 quarters, inventory destocking, and I think that process is largely complete. And what's interesting about that is we've been producing below levels of demand. I think that going forward into Q4, you begin to produce more in line with demand, and as that happens, you're going to see demand, or you're going to see production begin to step up. And that's going to help companies that are involved in maintaining facilities. It's going to help companies that are involved in the process of ramping up production. It probably will not help in the near term any companies involved in capital spending, but those that are involved in production or maintenance, I think that there probably is a nice 6 to 12 month period where earnings really get off their back that they've been on for the past 2-3 quarters.
Okay, Holden, if you can stay with us, we're going to talk more about the industrial sector and how to play the nascent recovery. Holden's picks include one from the house, one from the garage, one that's close to my heart. I'll explain. We'll show you what he's talking about coming up next. This is Taking Stock. Quick, think of 2 sectors of this economy that have been especially battered during the recession. If you said housing and cars, then you've also answered the next question. Where does Holden Lewis see 2 opportunities for investors? Welcome back to Taking Stock on Bloomberg Radio and Television. I'm Michael McKee. Holden Lewis is an analyst at BB&T Capital Markets. He's with us from Richmond, Virginia. Holden, you got a couple of stock picks that fit in the category of if you're beaten down, there's much farther down you can go, I guess. First one, Barnes Group, buy rated. It's a $19 price target. What do they do? Why do you like them?
Well, Barnes just makes and distributes general industrial products. I think what's interesting about Barnes, though, is less about what they make, though that's important, obviously, but what end markets they serve. They are about probably about 30 to 35% transportation, probably 25 to 30% aerospace, and the rest of it is a general industrial end market. Now, what I like about Barnes, however, is the market that you alluded to a moment ago, the automotive exposure. Again, we referenced the automotive production beginning to step up. In Barnes' case, Barnes is the name that I cover that has the most exposure to automotive. I think that in terms of revenues going into the big threes through some channel or into the OEMs through one channel or another, it represents 20 to 25% of total revenues. Now, it has not gotten the premium that some other names that I cover get that are in the automotive space, and I think that relates to the aerospace business. However, aerospace, remember, is coming up against an easy comp because of the Boeing strike from last year, is already down 20 to 25%. Inventories are weeding their way out, and I think that the aerospace and the general industrial businesses don't hurt us here as those markets bottom in the near term, but automotive production steps up and carries Barnes Group with it, and I don't think the valuation on Barnes is yet reflecting that improvement, which I think we'll see in July, August, and as we get into the third quarter.
$14.69 for the close on Barnes today. I have to ask, in this sector, are they a possible acquisition target? Because there's been a lot of consolidation in the auto parts market.
There has been. I don't think that they are. Quite frankly, I think that Barnes Group has been trying to consolidate away from the auto parts business to some extent, and successfully over time. But no, I don't think that they are a takeover candidate. The other businesses that they have don't make them a pure play, and I don't think make them a target. So I don't see that as being the exit strategy for Barnes Group. I simply see higher earnings going forward, and I think that that's going to sustain and, in fact, improve the valuation from where we are.
Now, another basic industrial company you like that, as I said, is close to my heart because its ticker symbol is MSM, which is my initials, MSC Industrial.
MSC Industrial, when we talked earlier about production stepping up and maintenance and production type companies benefiting, I think MSC is sort of a prototype in that regard. Half of what they produce, or half of what they distribute, I'm sorry, because they are truly a distributor, half of what they distribute is metal cutting tools. And so anytime you're going to be stepping up production in the industrial world, cutting metal is going to be a big part of that. And MSC Industrial distributes the products that are involved in that. So I'm a believer that that is an early cycle type of revenue mix, and as that production steps up, they're going to be a big beneficiary. However, distribution, bear in mind, Michael, is also a variable cost business model, but because of how MSC is built, they're more of a catalog shop than a branch shop. Early on in industrial cycles, they tend to drop more of their revenue to the bottom line than the other distributors in their peer group, and so we would anticipate their revenues reacting quickly to the improving environment, and we'd anticipate they'll be dropping more and more of that to the bottom line than even some of their peers. And I think that makes an aggressive play within the industrial distribution field.
You've got a $42 price target on them. They closed at $39.51 today. All right, your third stock is an interesting one because of the economy and the stimulus bill. Real Beloit, RBC is the ticker. What do you like about them? Where do they benefit in terms of the stimulus package?
Where they benefit, I mean, the first two things we like about them before getting to the stimulus package is, again, I think an early cycle type of revenue stream. 40% of the motors that they make go into the residential HVAC area. Obviously, that's been on its back but bottoming out, and of course, we think the same is true for the general industrial. So I think that as production steps up, you're going to burn out motors faster, and they're going to be prime beneficiaries rather quickly. On top of that, they've been very aggressive cutting costs, not only during the downturn, but also preceding the downturn. And you know, those advantages were masked by higher raw materials and then lower volumes. As those issues mitigate, I think that you're going to see margins really pop nicely on that name. Now, to your question, where do they benefit from the stimulus package? The stimulus package incents consumers to move up to a higher efficiency HVAC unit, which carries a higher price point, which carries a more sophisticated motor, which in turn carries a higher price point, and we think a higher margin. And so whereas you won't sell a single unit more, you will enrich the profit mix, in my opinion. There will also be another stimulus package at the end of 2010 for industrial motors, which will have essentially the same benefit. And I think that over the next 18 months, you'll see high efficiency go from maybe 15% of the mix to 30%, and that's good for profitability as well.
All right, and there's quite an upside here because you see a $56 price target. Today they closed at $45.46. Our thanks to Holden Lewis of BB&T Capital Markets.